Thank you, Helen, for being here. Maybe we can start off, actually, maybe you can go to the next slide, Cheryl, and I will, great. So quick cheat sheets, due diligence, industry jargon for all activities associated with evaluating an investment proposal, screening, initial due diligence to quickly flag deals that do not meet investment criteria, and term sheet, bullet point document outlining material terms. With that, let's go to the next slide. And I'm excited to have with us today Helen Ruan. Helen, thank you for being here. Maybe you can give a quick introduction and maybe share just a couple of areas that you currently invest in.
Okay, fantastic. Hi, everyone. My name is Helen Ruan. I'm calling in from Silicon Valley. My county was one of the first in California, actually in the whole US, to receive the stay-at-home order. So I'm really glad to be here. Cheryl, Sundeep, and other Republic team members, thank you for inviting me to this webinar. It's just nice to have this big online gathering during social distancing. So quick background about myself. I've spent over 20 years in the fast-moving Silicon Valley, held various leadership roles in technology, product, marketing. I've experienced highs and lows of startups, medium-sized, as well as Fortune 50 companies across about 10 plus tech sectors. And I was fortunate to have opportunities to work on iconic products that became household names or innovation categories for emerging markets. And I enjoyed helping 2 startups successfully exit within 15 months from my involvement, helping a mid-sized company to exit $1.2 billion within 3 years from my involvement. So today I wear multiple hats and they're kind of intertwined. So I am an angel investor. I advise companies in growth expansion, and I provide due diligence services for angel investors. In terms of investments that I'm focusing on right now, so I have been a long time investor. I've invested in traditional markets like real estate, stocks, mutual funds, as well as new markets, you know, the higher risk one, cryptocurrency, now angel investing. You know, I've traded, you know, public, you know, stocks, you know, Forex, futures, crypto. And that's where I learned a lot about risk management. And I enjoy angel investing the most. I do believe investing in private markets has a bigger potential upside, where most of the gains is made before companies enter the noisy public markets. As we all have witnessed today, you know, the public markets start crashing, right? As soon as the pandemic news start breaking out, you know, gains investors accumulated over years just got wiped out in a few days, in a few weeks. Of course, we're hearing some rebound news, you know, as you can look at the S&P index, but it's impossible for retail investors to predict the perfect timing in terms of when to buy low and high. Buy low and sell high. Let me make sure that I get that clear. So I think by investing in private markets, we are kind of shielded from all that public noises, that roller coaster, right? I also just enjoy the satisfaction that we gain as angels who can actually help entrepreneurs to bring their solutions to the market and create more jobs along the way. So I do provide due diligence services for investors, and I've seen investors, you know, struggle. So today I look at, you know, almost, I don't have a strong preference, like it has to be this sector, right? So I pick deals for myself, also for my subscribers, you know, across 20 plus different sectors, and they're in various stages.
Let's actually dive a little bit there. So how do you go about market research, whether it's evaluating business models or creating sort of your own thesis across these sectors that you just mentioned?
Yeah, interim market research, right? So I do have an angel investing formula that consists of 30 plus evaluation, you know, metrics, criteria to compare deals. You know, when people look at one deal, well, there's definitely something attractive about a deal, right? You know, they're looking at bringing something disruptive to the market, but as investors, we have to treat this as business. So in terms of doing market research, you know, at a high level, let's first identify which industry sector and subsector the company belongs to. Then I would research and validate the actual addressable market size, because it's very easy for companies to claim, oh, we're addressing 10 billion, 100 billion, you know, anything under the sky. That's not realistic, right? I mean, there are mature players in the market already. How do they compete? Well, what's the competitive landscape? What's the growth trend of existing players? Is there enough room for a new entrant, right? Is there enough, you know, pie for everybody to get a slice? Then I look at the
first things you do. Sorry, I just want to, again, for the audience, because there's so much content here, I want to make sure that they don't miss anything. One of the first things you do is if a company presents the market size, you go and you independently validate that. Is that right?
Correct. Yes. Because when people talk about industry, I mean, like even like food and beverage, right? It's such a broad industry, right? You have to look at the subsector, right? I mean, drinks, beverage, right? Or software, right? I mean, you can say everything is defined by software today. But again, there's specific software for, e-commerce, for business software, for software as, as a service. There's, data subscription services, there's AI, there's robotics, all include software. That's too broad. So we need basically go into the subsector to understand what's the actual addressable market size, right? Who are the players already? Does this company really have a competitive edge that they claim?
Got it. And so going to the next part of the question, and after you sort of validate some assumptions that the company presents, how do you evaluate business models?
Right. So, I'm not married to a particular business model because I have hands-on experience working at companies with, B2C, B2B, B2B2C, or B2B2B, right? It sounds very confusing. The bottom line is, can they make money, right? So I would look for proof points that these business models can actually generate revenue for the company. And not just only that, their margins, their growth trends, right? The customer feedback, the product reviews. And if they're in the pre-revenue phase, I follow their partnership deals, progress, right? If a founder says, I have letter of intents lined up in the pipeline, I would ping them. I said, hey, how's it going, right? I know it's, it's not NDA at this point, but, what is it trending, right? What are the pre-order sales? So this involves, not just days of tracking, weeks and months of tracking if you're trying to invest in a pre-revenue company.
Got it. So what I'm hearing is as you evaluate business models, it's understanding all the assumptions around everything from margin to go to market. And it sounds like your diligence process is something that isn't necessarily in days, but it could be weeks or months. You first engage with the company and then you sort of follow up on how they're doing. Is that right?
Yeah, and I actually monitor the company's progression during their raise period. And I love to see founders who are not just betting on the funds come in and then do something. Rather, they work so hard to prove investors that they're capable of generating revenue. They're able to gain market traction throughout the raise period. And that's really encouraging because they're not just being complacent, hoping, use investors' money as cash machine, but rather work really hard to do whatever they can to scale and, assuming the best case and worst case in terms of fundraising results.
Have you assembled your sort of due diligence checklist formula as you engage these companies?
Yeah, so I don't want to repeat too much of other panel folks have already discussed or will discuss, like I said, I have 30 plus criteria. I aim high. I personally aim for at least 10x return. If I have to invest early, take on more risks, and hold on to illiquid assets for several years, right? And so, we can look at the standard textbook term, product market fit. What does that mean, right? I really focus on finding proof points, validation that there is traction, right? That it is a well-fit product. I asked the question, is this a painkiller solution or just a candy solution? Painkiller solution meaning there is going to be a consistent demand for the products, right? It's something that people, feel like they can't live without, or something that's essential to enhancing their lives. I decouple that from, the nice to have categories. That's not to say the nice to have products won't do well. It's just that I reprioritize in terms of which ones are more essential, right? Especially in the context of COVID today. Fortunately, the companies I have invested or I'm interested in investing are the ones not just surviving, but actually thriving, under this economic downturn. Those are the things we want to look for.
I was going to say, let's kind of dive into like, as you're talking to these companies, so you have your checklist. But what are some key essentials you look out for when you're conducting due diligence? Just
on top of my head, sure. I definitely, as I mentioned, I would validate their TAM, right? Addressable market size, their competitive advantage, right? Their revenue growth. Is the company scalable, right? When is it going to reach profitability? The founder and the team, I would say that's the one that's really hard to digitize, the scoring, because, we're dealing with humans, right? And one can argue the founders who've had, successful past, may become complacent this round, right? Except for, there are exceptions like Elon Musk. He still works 100 hours per week. That's not everybody, right? And then you have first-time founders. They're more hungry. They work harder. They think outside the box. They do everything they can to get by, right? And then quickly survive and scale their business. So, again, in the interest of time, I don't think I can really, talk too deeply, I'm just going to give a quick example. Like you look at the founding team, if there are too many people on, sitting at the table, right, you can pretty much expect there's going to be office politics. It doesn't matter if they're family members or not, just too many decision makers. It's really difficult to move forward. Again, we can generalize that, but oftentimes that's what happens, right? Now, if you have just one founder, but there's also the founder syndrome where this is his baby or her baby, right? They're going to do everything, they work themselves to death. Again, if they get sick, who's going to continue the business, right? So you want to have a fine balance where the founder is not only a capable individual, but also can lead and build a team that's going to sustain and grow the business, right? Valuation terms, I'm huge on that. Again, I won't repeat what Erica just mentioned. On crowdfunding sites, right, as smaller, retail investors, we don't have the luxury to negotiate terms and valuations with the founders, right? We basically deal with whatever's put in front of us. And that's where investors should not have to settle, right? You have to be picky, right? Look at your, investing goals, right? Look at what kind of risks you're willing to take and take controlled risks and be really picky. So I obviously have my own formula in terms of what I think the valuation is reasonable. And that's where the deeper due diligence is involved. It's not about investing in the lowest valuation cap means the best deal. That makes no sense. It's about in the context of what they have achieved, right? Where are they going, right? Who are they competing with? And also just the quality of the founding team and development team.
Got it. So just to repeat back, what I'm hearing is as you diligence and you evaluate things such as terms, there's sort of a lot of factors that kind of can factor into whether it's a fair price.
Exactly. Yeah. And it's different. Yeah. Every industry sector is different. And maybe 5 million in one sector is considered a very good deal, but it may or may not, if a company is still pre-revenue and, there's really no proof points that it's going to be successful.
You mentioned COVID. How is COVID changing how you evaluate companies from a due diligence perspective?
I definitely put more emphasis on the companies who actually show proof points that their sales actually went up, as the pandemic started. I think that's a really positive sign. That means, their product solutions are somewhat recession proof, right? And the ones that can actually contribute to COVID relief, obviously that's definitely, valuable, right? But I also want to make sure that, companies are not just capitalizing on the public fear about the pandemic and, tie their names to COVID-19, right? They actually have something that, can prove they're either helping, contributing, or there's going to be huge demand once we start recovering.
Fair enough. I was looking at some of the questions from the audience, which I think we'll have time to get to. What are some red flags? Just some total non-starters as you do due diligence.
Inflated valuations. Now, just because a company's founders went through a startup accelerator program, right, it doesn't justify a $10 million valuation without generating a dime. If their company is truly worth $10 million today, someone's willing to pay for it, I'm sure they can sell it, right? But they're not selling because no one's buying that. But there are exceptions, right? There are a few founders saying, I won't sell the business no matter what until I grow into a unicorn. It's possible, right? I don't want to generalize here. So I think we should really look at inflated valuations where there's no revenue data, there's no sign of profitability in the foreseeable future and demanding very high valuation because, the whole, thesis of angel investing is that we take early risks, but also we want to buy low and hope, can easily sell high. We don't want to buy high and hoping to sell high, right? Another form of inflated valuation is where companies, they will come back to do multiple raises, right? And they tend to, it's reasonable to raise the valuation that's consecutive rounds, provided, they have shown proportionally more revenue, market traction, profitability, right? Just because they got more money, whether it's through private raise, a public raise, they just pat their valuation. That money investor gave you is not money earned, right? It's not the same as profitability and revenue.
Go ahead.
I
was going to say on the flip side. So as you've done due diligence, I mean, you have a deep history and domain expertise here. What are some I won't call them green flags, but things that you see when you're doing due diligence that give you a little more comfort that you've seen kind of time and again as being a good sign or promising?
Yeah. So, there are definitely founders who have demonstrated, very disruptive, either disruptive technology or disruptive business model. It doesn't have to be high tech, but has a very disruptive business model where they realize the traditional business model weren't making money as quickly as, as they would like to, or plateaued, right? So they'll come up with innovative ways. Even the food beverage industry, if they have, online e-commerce platform, right, that can supplement, the income, or in the case of COVID, right, can actually even replace, because physical stores are forced to shut down at the moment, right, then they have more versatility to survive, right? And definitely the margins, if founders are actively improving margins so that we know the company can sustain themselves without coming back to investors, every 6 months, 12 months, ask for more money, right? Patents probably matter a little bit more in the healthcare medical device area, because they do take a longer time to really materialize, because just FDA approval process itself takes a long time. So I've seen some of the healthcare companies can literally actually license their patents, before actually the device hitting the markets, and that's a possibility, right? But there's no fixed rules, right? And I think really the founders themselves are personalities where they're humble and confident at the same time. They're willing to take inputs from investors, to say, hey, there's something you can improve with your product. I really enjoy working with those kind of founders who are, fast moving, but also staying humble at the same time.
Yeah, open to feedback. As we summarize here, kind of if you were to leave folks who are tuning in for due diligence best practices with just the 1-2 like absolute takeaways you want them to take away from this conversation?
Well, I think first of all, folks really need to focus on diversification, right? There's a reason I myself and I publish, deals in 20 plus sectors, because it's different from invest in public markets, right? These are the ones that, we don't know how a company is going to, perform and grow in the next 3 to 5 years. And even somebody who has worked in multiple industries, right? Nobody knows it all, right? The world is constantly changing. We're constantly changing. So diversification is one of the most effective methods to increase the odds of successful investing. And 2 is don't bet the farm on anything, right? Just pace yourself, right? This is a journey, right? You can build a portfolio of, tens and dozens, over hundreds, over the course of, multiple years, right? Don't try to jump on a deal just because you like it. 3 is not to follow the herd mentality, right? And again, this is your own money. This is different from venture fund, right? It's not somebody else managing your money. It's your own money. You know your risk tolerance better than everybody else, right? So don't just jump in a deal just because, oh, it sounds good or the momentum's really high. Do what's comfortable to yourself.
That is such a great roundup. Thank you, Helen, for your time. And we'll turn it back over to Cheryl.